Imagine instead of being confused or anxious, you're ready to make your next options trade with complete certainty, knowing precisely which stocks to choose. What if we told you that in 2025, it might be easier than you think to choose the best equities to trade options on? Simple, effective advice that anybody can apply to make better decisions without resorting to guessing or complex formulae. If you can bear with us for the upcoming minutes, we will teach you how to locate the most lucrative options deals with little effort on your part. In the mood to trade like an expert? Let's begin. Number 1. Fundamental stock selection. Where to search. Choosing stocks for options trading requires initial knowledge of the reality that not all stocks are created equally. While certain stocks could leave you disappointed and caught with a poor trade, others are more suitable for options trading. How then would one locate the appropriate ones? Starting from equities with great liquidity and trading volume will help you most. For what reason? So trading high-volume stocks is simpler. They usually feature tighter spreads, that is, the gap between the buying and selling prices, and let you get in and out of positions fast. This is vital since it ensures you're not losing money leaving a transaction and you're not paying too much to start one. The catch is, though, it's not just about any volume. You want equities with adequate activity to guarantee flawless trade execution. For choices, search for stocks with at least 500,000 daily traded shares. This guarantees adequate mobility so you may profit from market fluctuations without finding yourself in a difficult-to-leave position. Where might one locate these high-volume stocks? Look at liquid popular equities like Apple, Tesla, or Microsoft that are routinely traded. These stocks are frequently attractive candidates since they have high trading volumes and draw options traders, therefore increasing their predictability and simplicity of trading. All things considered, concentrate on very liquid and voluminous equities. This is the basis if you wish to guarantee quick and effective execution of your deals. As you travel farther into your options trading path, be sure to monitor these elements. Number 2. Analyzing implied volatility, or IV. Knowing where to search for quality stocks currently will help us explore implied volatility, or IV, one of the key considerations in options trading. Though it sounds technical, remain with us since this will greatly increase your capacity to choose the best stocks for your option trades. Based on the options pricing of a stock, implied volatility indicates its future predicted movement degree. See it as a stock's equivalent of a weather forecast. IV forecasts how probable a stock is to show significant price swings, much as weather forecasts estimate rainfall likelihood. But instead of staring at clouds, you're seeing how much buyers of options on that stock are ready to pay. Why should this matter for trading options? Well, since traders expect more significant price swings, the options get more costly the higher the IV. If the IV is too low, the alternatives will be less expensive, but you may not find much activity. Finding that sweet spot, where the IV isn't too high or too low, is thus absolutely vital. How therefore can one determine the appropriate IV for options trading? Look for stocks with modest to high implied volatility generally. While stocks with very high IV could be excessively hazardous, stocks with low IV might not provide the large price movements you wish. Try for stocks with an IV of 30 to 50% to find the equilibrium. Without running too much risk, this range usually indicates that there's enough possible movement to execute winning trades. And here's a pro tip. Glancing at the options chain on your trading software can reveal the IV of any stock. Usually stated as a percentage, this figure is, once you're at ease with this, you'll be able to quickly find strong prospects by looking at the IV. In essence, implied volatility helps you understand the possible movement of a stock as well as your expected option payoff on that asset. The secret is locating equities with modest to high IV, not too high, not too low. Number 3. The value of income reports. If you've been investing for some time, you already know that stock values may vary greatly depending on earnings reports, particularly in cases when the results are better or worse than predicted. These quarterly performance updates from the company sometimes cause significant fluctuations in the price of a stock. For options trading then, why do earnings reports matter? The expectation of this news generates volatility. In options trading, volatility is exactly what we wish for. Traders value options more since they predict significant price swings when a company is due to publish its earnings. Though your timing must be meticulous, these price movements may offer excellent chances for profit. Time is the secret to properly using financial reports. You want to avoid mindlessly buying a stock just because of its earnings report is forthcoming. Consider it like checking the weather before a hike. Knowledge of what to expect will enable you to make future plans. Do your study before the report is released. First, normally disclosed in advance, find the date of the earnings report. Most financial web pages have this right underlined. Look at the expectations of the general market then. If experts forecast high earnings, the stock may soar following the announcement. Knowing how the stock usually responds to earnings announcements is also quite vital. While some stocks might not change after earnings reporting, others often do. Examining historical responses helps you to better understand possible behavior of the stock following the next report. Knowing when the earnings report is due and what the market expects can help you to decide how to approach the trade. Some traders hope the price will move significantly in one way. Hence, they want to acquire options before the results announcement. Others wait until after the report to trade the usually occurring volatility. Depending on your level of situational awareness, both strategies can work really effectively. In essence, although they are not certain, earnings releases can cause significant market swings. They present a chance only if you are ready. Before trading, always be sure you do your homework, know what to expect, and create a strategy. Always remember too, never risk more than you are ready to lose. Number 4. Selecting stocks with technical analysis. Let us now explore technical analysis after we've addressed volume, implied volatility, and earnings reporting. One of the most effective instruments in a trader's toolkit, this will provide you an unambiguous understanding of which stocks are suitable for action. If you have never used charts before, relax. Technical analysis is something you can start utilizing straight away and is not complicated. Fundamentally, technical study is all about using market trends and price patterns to forecast future stock movements. By seeing these trends using charts, you may better determine if a stock is likely to rise or fall in the not-too-distant future. The best thing is that using technical analysis does not require genius. Rather, a little amount of skill and a few important indicators will significantly change your trading approach. First of all, your best buddy is price action. How a stock has been moving. Examining the chart of a stock will help you to notice its recent highs and lows. Generally speaking, a rising stock indicates that it might keep rising. But if it is moving down, you might choose to avoid it. But here's where it becomes very helpful. Degrees of support and opposition. These are the ranges of prices a stock usually swings within. A stock often recovers when it reaches a support level. It often falls when it reaches a resistance level. For options traders especially, knowing these levels will enable you to forecast where the stock may move next. Let us now discuss some simple signs. Telling you if a stock is overbought or oversold? The Relative Strength Index, or RSI, is among the most often used ones. If the RSI exceeds 70, the stock may be overbought and a pullback could be appropriate. When the RSI is less than 30, the stock may be oversold and purchasing at this point could be wise. The moving average, or MA, which guides your identification of the trend direction, is yet another important statistic. Two most often utilized are the 50-day and 200-day MA. A bullish signal, that is, if the 50-day MA crosses above the 200-day MA, indicates that the stock might be about to rise. If it goes below, this is a bearish indication, suggesting the stock might slide lower. Combining these indications with the price trends helps you to get a much better view of the perspective of the stock. It's about looking at the complete chart, spotting trends, and verifying those trends with the appropriate indicators. Not only about staring at one thing. Little practice will help you to identify strong stocks for option trading using these instruments. The secret is to constantly be aware of major indicators, the degree of support and resistance, and the price activity. When choosing successful stocks for options, technical analysis may become your best buddy. Number 5. Learning risk control. The last piece of the jigsaw is risk management. Now you know how to choose stocks, grasp implied volatility, and use technical analysis. Most traders either succeed or fail right here. The top traders in the world also understand that you cannot enter a trade without thinking through the associated risks. Actually, controlling risk typically separates long-term financial success from losing everything in the blink of an eye. Though highly risky, options trading can be rather profitable. To live and flourish in this game, then, you absolutely must have a strong risk management plan. In option trading, then, what does excellent risk management look like? Establishing stop-loss orders is another fundamental component of controlling risk. A stop-loss is a predetermined price you will automatically close a trade if the stock moves against you. This is like a safety net, keeping you from losing more than you are ready to risk. This is especially crucial for options trading, since options can lose value rapidly, and you must guard yourself from large fluctuations that might wipe out your gains. Profit-taking rules are just as crucial as stop losses. This means even if the stock is still moving in your advantage, understanding when to benefit from a trade and leaving it. Here, a decent approach is to decide on a target price or a percentage gain. Once you reach that target, stop trading. Getting hungry and hanging on for more money is simple, but this usually results in losing your winnings. Stay to your strategy and profit when it makes sense. Remember also the need of diversifying. This does not imply you should invest all of your money in one stock or even one industry. The top traders divide their risk among several equities and even several kinds of option techniques. Diversification helps lower your risk to any one poor trade or unanticipated market event. Good risk management, then, is about safeguarding your cash, prudent trade management, and recognizing when to get out from underperformance rather than about attempting to perfect the market or profit greatly on every trade. Strong risk management will enable you to trade boldly, knowing that even if you incur some losses, you have developed a plan that will keep you in the game over time. Remember that success does not come overnight. Even now, you have the tools to choose the best stocks for option trading. It's about consistency, study, and wise judgment. Long-term success will be yours if you concentrate on stocks with good volume, no implied volatility, monitor earnings reports, apply technical analysis, and control your risk. See you in the coming video.